The Federal Reserve is meeting today, and for the first time in years, the most important person in that room might not be the chair. Kevin Warsh, a name Wall Street has tracked for over a decade, is now sitting at that table, and prediction markets are already pricing in something unusual, a more united Fed board than we have seen in recent memory. The question every serious investor should be asking right now is not whether rates move today. It is what Warsh's presence signals about where monetary policy goes from here, and whether that changes how you should be positioned. Let's start with what the headlines are actually saying, because the framing matters. Kalshi, one of the more credible prediction market platforms operating in the U.S., is showing traders pricing in a more united Fed board at this meeting, specifically because of Kevin Warsh's presence. That is a specific, measurable signal worth unpacking. Who is Warsh? He served as a Federal Reserve governor from 2006 to 2011, which means he has a front-row institutional memory of the 2008 financial crisis and its monetary aftermath. He has historically leaned toward a more hawkish interpretation of the Fed's price stability mandate, meaning he tends to prioritize controlling inflation, even when that creates short-term economic friction. Markets have long speculated about his potential influence on Fed direction, and now the speculation has a concrete context: his first formal meeting. Here's what the prediction market signal actually tells us. When traders price in a more united board, they are not saying everyone agrees on every decimal point. They are saying the probability of a public dissent, a formal recorded vote against the majority, is lower than baseline. In Fed history, dissents matter. They are one of the clearest signals that internal consensus is fracturing. And fracturing consensus tends to create uncertainty premiums in rate-sensitive assets, like long-duration bonds and growth equities. The actionable insight here is not to trade the meeting itself. It is to understand that if Warsh is bringing alignment rather than friction, the Fed's forward guidance is likely to read as more coherent and deliberate than recent communications have been. And coherent Fed communication, historically, narrows volatility in the weeks that follow a decision. Watch the statement language closely. That is where the real information lives today. Now let's talk about the economic backdrop the Fed is actually operating inside, because this is where the story gets more complicated than the headlines suggest. The dominant narrative heading into this meeting is inflation. The Fed's entire decision framework, hold cut, or signal a path, is anchored to where price pressures are tracking. And while we do not have today's U.S. print in the headlines, we do have a data point from the U.K. that is worth examining analytically. UK inflation held steady at 2.8% in May 2026. That number is meaningful for two reasons. First, it shows that in a comparable developed market economy, inflation has not returned cleanly to the 2% target. It is stabilized but above it. Second, the UK and US economies are not identical. The UK has its own labor market dynamics, energy exposure, and fiscal position. But both central banks are navigating the same broad post-shock environment, an attempt to normalize policy after years of extraordinary intervention without triggering a hard landing. Here's the analytical thread that matters. If a peer economy is sitting at 2.8% with inflation holding rather than falling, that tells you something about how sticky this last mile of disinflation actually is. It is not a straight line down to 2%. It is a plateau that central banks are now managing against a backdrop of political pressure, employment data, and global commodity prices. Speaking of commodities, oil is ticking higher today, according to the same morning coverage. Oil is not just an energy price. It is an inflation input, and it is a signal about global demand expectations. A rising oil price on a Fed decision day is not dramatic, but it is a subtle reminder that the inflation story is not fully closed. This is not financial advice, but understanding these macro linkages is exactly the kind of edge that separates reactive investors from anticipatory ones. The third piece of today's picture is the market itself, and here I want to push back against the most common misreading of a quiet open. S&P 500 futures are little changed this morning. Most financial media will frame that as calm before the storm, or markets waiting. Both are technically true and analytically useless. The more precise interpretation is this: the market has already done most of its pricing work. When futures are flat heading into a major catalyst, like a Fed decision, it almost always means one of two things. Either the outcome is heavily consensus, has high conviction about what it will hear, or the range of outcomes is so wide that positioning before the announcement is structurally unattractive. Given today's specific context, a new figure in the room, a sticky inflation backdrop, and oil moving higher, the flat futures read is more likely the second scenario. Sophisticated participants are holding off, not because nothing matters, but because the distribution of outcomes is harder to price cleanly today than at a routine meeting. This is an important discipline for any investor watching this in real time. The instinct is to act on a Fed decision day. The data-informed behavior is to recognize that the post-decision statement and press conference often contain more directional information than the rate decision itself. Has the Fed's language around future cuts shifted? Does the dot plot, if updated, show a different trajectory? Those are the actual data points that move 30-year bond yields, and by extension, equity valuations in the sectors most sensitive to rate expectations: real estate, utilities, and high multiple technology. The flat line in futures is not a green light, and it is not a warning. It is the market's honest acknowledgement that it does not yet have full information. That is a rational posture, and it is the one worth mirroring until the statement drops. So here is where we landed. The Fed meeting today is not really about a single rate number. It is about what Kevin Warsh's alignment signals for the next 6 months of monetary policy, set against an inflation backdrop that both the US and UK are showing is stickier than the optimists projected. The open question we have not answered yet: if Warsh is a hawkish unifier, what does that mean